My name is Steve Platt. We're talking crude oil. We seem to be at a key inflection point. One thing I've learned from commodity markets over the past years has been that high prices begets low prices, and just the opposite can occur, whereby low prices can beget high prices. And we're starting to see that in the market today. There's been key signs of production moving down in terms of OPEC making critical decisions here the past week to cut their production by 1.2 million barrels. The key members, Saudi Arabia and Russia, along with even the United States, account for over 40% of global production currently. I think you have to consider that that type of cut can really have a dramatic impact on prices. At this juncture, the market has not responded. Russia has been reluctant to make the cuts in any strong fashion. Saudi Arabia appears committed to the agreement, but we are raising some questions on how quickly the balance to the market will actually occur. There is certainly some adjustment even going on in the U.S. with respect to rig counts. And also in Canada, you have also seen the rig counts decline. So on the non-OPEC production side, which was not affected by the OPEC agreement, we have seen moves afoot that could cut production as well. On the demand side, global demand is topping over 100 million barrels and likely will continue to climb as we move into the new year. The global and growth prospects are certainly still up for doubt, and that in itself will provide the basis, I think, for some uncertainty in the marketplace as well, at least in the near term as we move into the first quarter. That could provide the basis for a modest increase in stocks, which should actually lead to potential pressure on values as uncertainty develops on how effective the agreement is as we move through the first quarter. As we come into the second quarter of next year, I think there's some potential for the market to recognize that some tightness could occur, and that to provide some basis for values actually rallying. The supply-demand balance is going to be a key consideration as we move through 2019. And I think if everything goes as planned with a widening deficit, it should start to be reflected in those back months. Currently, the market has generally held in this $50 area. Looking at values, we do have the potential still to possibly break down to that $47, maybe even $45 area. But if we start seeing some tightness and some demand for nearby crude absorb some of the excess stocks during the first quarter, you should be able to get an additional rally in anticipation of Iranian production and maybe even Venezuelan production coming down, along with uncertainty recently associated with Libyan production, helping to firm up values as we look ahead. These thoughts are my own and not those of ADM or ADM Investor Services or Archer Financial Services. Have a happy trading day.